We've got a really great panel coming up now, which is focused on the global capital flows, and particularly bringing some of those thoughts from David then also into what that means for real assets, and particularly the flow of global capital. So the panel this morning is Simon Mallinson, who's Executive Director for Real Capital Analytics, Daniel Harris, who's a Principal and Head of European Investments at Cain International, and Jason Oram, who's a Partner and Fund Manager at Europa Capital. Thanks very much for joining us. You can ask questions, by the way, and I'll make sure I deal with those. Those are all in the in either the mobile app or the web app, depending on which you're using. But please do ask those, and I'll also be able to pick those up and make sure we answer your questions. For now, let's just start with introductions. Let's start with you, Daniel, and just give a very brief overview for those who may not know, just about you and Cain International.
Sure. So, hi, my name's Daniel Harris. I'm Head of Investments for Cain International in Europe. We're a real estate fund manager, and we do three things really. So we do equity investments, we do debt investments, and we do more private equity operating businesses. And we operate across the US and also across Europe. And what's interesting about us is that we also we raise funds, but we also invest on our half of our own balance sheet. So the last few years, we started off as a business, particularly investing off our own balance sheet and the balance sheet of our parents. And then most recently, we've moved into the funds business in the last couple of years. I joined about 2.5 years ago, and we've moved investing into a sort of a more pan-European value-added fund structure. But over the course of the last couple of years, we've invested just under $6 billion across those three strategies of equity, debt, and private equity.
Great, thanks very much. Jason.
Good morning, all. Jason Oram, partner at Europa Capital. We're a pan-European private equity real estate investment management business. We've been operating 25 years, and we represent client capital from around the world. We do both equity and debt investment strategies, but we're probably best known for our pan-European investment activity, value-add investment activity. I am an executive committee member at Europa, so along with two others, we're responsible for all aspects of the business, but I am more specifically responsible for the fund management of our value-add series. Thank you.
Super, thanks very much, Jason. Simon.
Hi, good morning, everyone. Simon Mallinson. I am at Real Capital Analytics. Real Capital Analytics is a global business tracking transaction activity in over 170 countries. Most of our clients are active participants in the market. We've been doing that for over 20 years, and our data offers insights into what's going on, who's buying what, where, and to some degree why. And my role involves responsibility for our European and Asia Pac business, and also our global analytics output, which obviously includes the US as well.
Super. Let's start with you, Simon. I mean, obviously it's been an extraordinary past 7 months, but let's try and put that into a little bit of context. So when you're assessing the sort of, let's look at the past 12 months. Just give us an overview, if you can, on your kind of views of I guess what the trends have been and where we're heading in terms of capital flows. What have you been seeing?
Sure. Well, actually, if we go back to the first quarter of this year, which is a good sort of point for where we could have been. If you looked at the US in mid-March, you would have seen numbers, activity in the market, which was well above 2019 and 2018 levels. So actually, the momentum that we were seeing in 2019 was continuing well into 2020, and we're seeing very strong activity numbers, I say, in the US and North America in general. Similar in Europe. Europe's last high mark was 2018, and in the first quarter of this year, 2020, was actually sort of bang on and slightly above the 2018 levels. So actually, it looked like we were in for a sort of pretty good ride through the year. The warning signs were largely there already, though, because Asia got hit hard early, its sort of impact from the ravages of COVID started in December, and obviously clearly started hitting the economies across Asia in January onwards. We saw the lockdown start earlier, and the volumes never really got going in Asia through this year. So as we reach sort of, effectively now, volumes are down sort of considerably. They're down 40% in Asia Pac and in the Americas, and they're down a little less than that in Europe. Europe's been a little bit more resilient, but that's helped a little bit by some big deals that have been happening. And I think some of the things that we can talk about in more detail on the panel, so I won't go into too much now, but some of the things that we're seeing in 2020 are continuation of trends that were already embedded in 18-19, things like a little bit of weakness in the hotel sector, some issues obviously in the retail sector, which I think are very well documented. The logistics sector was performing very well. So all of these things have been exacerbated by the health crisis, in the sense that retail has obviously been hard, hotels have been hit even harder, and logistics, for instance, helping people get goods to their houses has been incredibly important. So those sectors that sector is doing very well. What I think was surprising and maybe sort of took some investors by surprise to some degree is how hard hit offices have been. For instance, it's who foresaw that the downtown Manhattan or central London would be deserted. Apartment sector, again, who foresaw that apartments in New York that were in demand 12 months ago would suddenly be empty of renters as they move back to their homes, their family homes across the East Coast and other parts of the United States. So there's some sectors which have been hit surprisingly, and investors going forwards need to start sort of thinking about how they model that and how they how those trends might play into their investment strategies going forward. But it's as you say, as you know, it's an unusual period. It's a strange year. We've never really been through this. Even the GFC was different in the sense of its impacts to what we're going through at the moment.
I mean, that's interesting. Let's just pick that up a little bit. Jason, I mean, there's been a lot of attempts to compare, I think, between the global financial crisis and this current crisis. I suppose, how do you see those two in sort of comparative in terms of the capital flow side?
Well, they are very different. I think fundamentally because the cause is very different. It's perhaps oversimplification, but this is a consumer crunch versus a credit crunch, but it could yet turn into the latter. And I think the role of real estate, therefore, in the cause is very, very different. There was a toxicity associated with real estate as we went into the global financial crisis that, aside from, reductions in the availability of capital globally anyway, they were withdrawing fastest from the real estate sector. And I don't think that same association exists this time round. But as Simon was just highlighting, there is a wariness of how this consumer crunch is having an impact on certain real estate sectors. To the second point, the amount of liquidity, the capitalization of the industry is completely different this time round compared to the GFC. Dry powder available for investment in European real estate is at its highest. $70 billion, and that's an extreme contrast to the situation during the GFC.
Yeah, that's interesting, and it picks up David's point there in the presentation. I think about the possible amount of dry powder, and also where else is capital going to look given the low bond yields. Daniel, what's your sense of that? Do you see capital kind of standing on the sidelines despite the fact that there's a lot of dry powder? I suppose, what are you seeing? What do you expect to be happening over the next 6 months, really?
Look, I think, like in any crisis, people pause, take breath, think about, what should our next move be? And the initial stage of any crisis is protect what you've got. And I think that's what most businesses do. That's what we've did. And then you figure out how your own portfolio is going to be impacted. And that's the same for all real estate investors, whatever asset class you're in, or whatever sector you're in, or whatever sort of part of the capital stack, whether you're core investors or core plus or value add. And then, as we talked about, as there is so much dry powder, people start looking at where are the opportunities. And when you've got rock bottom interest rates, you've got low bond yields, you've got stock market in the US, for example, practically back up at its peak, people are going to look at real estate as a good investment. Can you buy something at 3, 4, 5%, and you've got interest rates at zero? And, they are going to be, I think it's recognized, interest rates are going to be at zero for a long time as we work our way out of this crisis. I think real estate still has some significant attractions. And I think people will be moving to try and probably increase their real estate exposure over the next few years.
Interesting. And just in terms of your sense of, I suppose, what the capital is looking for, Daniel, do you think there's going to be more of a focus on areas like debt, for example, or do you think it's still going to be sector driven? What's your sense of that?
I think in any crisis, the first thing you get is a slight liquidity crunch. So debt becomes very appealing at the very beginning. People, I was doing this project, I now need to find some bank debt for it. And because people aren't looking to initially buy something new, they're looking to deal with what they've got. Therefore, debt is really the first place where capital goes. And I think there's very, very attractive opportunities in the debt space, really across all of it, from core to value add. I think as time moves on, people will look to get much more exposure to equity as certain parts of distress come into the market. And if we go back to the financial crisis, there were still distressed deals in equity 3, 4, 5 years after the financial crisis. So where we are today, 6, 7 months post sort of the start of this, this current pandemic and the current crisis, you're not expecting to see any of those distressed deals really today. There's always the immediate distress. Someone has something, it blows up instantly. But over the longer term, you expect to see the markets sort of find their way through, and there'll be winners and losers over the next 2 to 3 years. So I think debt is definitely the place to look at the moment. I think there is opportunities on the equity side, but really, I think the equity side will come more into its own in 2021 and going into 2022. Okay,
good. And Simon, obviously there's looking at some of the deal volumes that there have been. There's obviously been more of a focus in terms of, I suppose, domestic investors. But what are you seeing? Are you beginning to see, and because you're having the data coming through, obviously, are you beginning to see more international cross-border capital moving and coming back again, or do you see it still going to be mainly domestic markets for a little while, and then those kind of cross-border capital flows begin to build from there?
Yeah, it's a great question. If we look at some of the markets that have performed well in the first half of this year, particularly in Europe, those have been markets which have been heavily dominated by domestic capital. So Germany, for instance, has performed well. In fact, Q2 numbers, Q2 activity for Germany was actually above where it was last year. And that's largely driven by domestic activity, is domestic investors investing locally. Similarly, Denmark and the Nordic countries have done pretty well because they've got a very strong historical domestic capital base. The UK is weak. We'll come back to sort of the UK in a moment, but if we excluded if we exclude the big sort of deal that happened in the UK, which is Blackstone's acquisition of the IQ student housing portfolio, the UK would have recorded its worst transaction activity since RCA records began, in the early 2000s. So, and that's partly because domestics have not been active in the market, and cross-border money has pulled back a little bit. And some of that's COVID, some of that's still Brexit uncertainties because we've not yet hit Brexit proper. At least after the transition period. In terms of your question about cross-border capital, linked to that sort of Blackstone deal, we've seen some pretty significant what we would term entity level deals or platform deals that have taken place, which have been backed by international money. That international money is, really interested in those big deals, those big platforms where they can place a lot of capital in a single go. Where we've seen less cross-border activity is in the smaller deals. It's the deals sub 50 million. Where generally there's been a lack of activity, but also particularly lack of cross-border activity. So it does seem there's a bit of picking and choosing by cross-border money. Those who are, those who are a bit can afford the big sort of tickets are still active, and that obviously pushes up the volume numbers. But in terms of actual deal count, they're actually quite low at the moment in terms for cross-border investors.
Okay, and Jason, in terms of, I suppose the strategies, there's been a lot of focus on residential. There's been a lot of focus on logistics, for example. What's your sense of that? What do you think capital is looking for? Do you think that's changed because of the crisis, and do you think that's a temporary change or a permanent change? What's your sense? Difficult one, I know.
It's thanks for that. Very hard. There's an incredible amount of speculation on where we're seeing embryonic trends that are going to be reflective of permanent change. I personally feel it's far too early to be sure about any of those. But yes, as was being said earlier, the pandemic has caused an acceleration in certain trends that were evident before March this year, in particular in the retail sector. You already mentioned the fragility around residential. It's not going to be a winner in every instance, but of course, growing populations mean that people will need more roofs above their heads, but where they need them, is still uncertain. The future need for offices, covers a huge amount of debate. We as an investment business still very much believe in the creativity that comes from physical collaboration and physical workspaces, and much of the reasons why cities exist is not simply because work is there. It is because they are vibrant, exciting places to spend time outside of work as well. And I don't expect that to be, thousands of years of working towards that vibrancy to suddenly be dissipated in just 6 months. So yes, there is sectoral divergence emerging, but I think as was mentioned earlier, it was evident before, but is being accelerated. I think what's yet to be really to come to the fore is within sectors to have a greater understanding of covenant dissertion. So whether within the office sector we will see significant divergence or scrutiny now placed on covenant strength. Same within retail. There's already been some murmurings as to how retail warehousing has actually proved through the crisis a more resilient performer than some other formats, even the previously always heralded high street retail. So too early to say. I'm sorry, I can't pin my colours to the mast on permanent change, but definitely seeing sectoral divergence.
Yeah. But it is just to Jason's point about covenant. It is actually a great sort of point because a lot of research, a lot of analytics goes into sort of capital flows, yields, all that sort of trying to understand sort of that sort of pricing sort of metrics. Very little historically has gone into sort of understanding the income side, the income analytics. I think that's going to need to change going forward. More focus on credit ratings. The credit rating agencies may need to sort of sort some of that sort of problems out outside of some of the more developed markets about how you credit rate some of these tenants. But it is, I think, I think Daniel mentioned this earlier as well. One of the attractive natures of real estate is its income producing capabilities. If that is impacted badly by the fact you can't understand whether a tenant has a strong covenant or not, then that's going to impact the sector in a much sort of larger way than we may have experienced in the past.
Yeah, I mean, one of the things that David Riley picked out as well was that sort of impact ESG investment side being driven by capital quite a lot. Daniel, do you expect to see that kind of gain even more traction? Do you think that's one of the things that's been accelerated? That focus on the ESG side, particularly from the capital sources, looking at where they want to invest?
Yeah, I think it will. I think, this crisis, and as we've talked about, it's done, the most interesting part of it is it's really just sped up trends that were happening. Like with Jason, we're a big believer in offices for all the reasons we talked about: cities, vibrancies, corporations. I'm not sure if you saw in the news yesterday, but I think JP Morgan said they want everyone back to work in New York. They're realizing that there are huge inefficiencies in not being in the office. And, as someone once said, someone senior at a big firm to me, working from home is the privilege of the privileged. When you're the CEO and you have a nice garden and a nice office, a nice study, it's very easy to work from home. When you're a junior person in a flat share, or you don't have a garden or outside space, working from home can be very isolationist. So I think on the going to the ESG point, there've been a big trend in offices, particularly to cram more and more people into offices. The whole thing was, how do we go from, previously it was 1 to 10. Now it's how do we get down to 1 to 6? And I think whatever way you look at offices, and my belief is that where there'll be some issues over the next couple of years, people are going to want offices where there is going to be, the trend is going to be, I don't want to be crammed in anymore. And the idea that you are sitting, shoulder to shoulder with your colleagues it's not really going to be an acceptable way to have your office anymore, and that's not going to attract talent. And in terms of ESG, you're seeing people, in terms of trends, people want to, the whole trend at the moment in the UK is people cycle to work more. They get electric scooters, they walk. And I think that whole ESG strategy is becoming a bigger and bigger part of people's lives. And when you're developing buildings or you're buying buildings or investing in buildings, you can't ignore the macro trends that are going on around you. And the macro trend is to have a greater focus on ESG. And I think in terms of the way you lived your life and the way your business operates and manages and the way it treats its staff. So there's no question that is going to be a much, much bigger part of the real estate industry as it becomes a bigger part of, of society.
And that's an interesting point. And do you think, just in terms of the fundraising side, there's obviously going to be particular strategies that are going to be more popular. How easy is it at the moment to raise funds? Are people beginning to look at raising distressed funds, given that there's going to be, or at least, it looks very much as though there's going to be a large economic crisis following this? What's your sense of that? I don't know, Simon, whether you're seeing anything in the market in terms of funds being raised or not, or.
I mean, there's obviously lots of surveys out there about sort of capital raising. And I think the one that sort of I think Jason was referring to earlier, has recently sort of put out, a lot of the capital raising has been for value add and opportunistic strategies, which suggests some level of, opportunity hunting in terms of distress in the market. Certainly when we look at our numbers, because we track obviously distressed sales, we track sort of distress that has been resolved, and we also track assets which are troubled, for a whole host of reasons. The distressed sales is peaked a little bit earlier in the year, but actually has fallen back to sort of reasonably low and normal levels. What has spiked is the number of assets that could be or potentially troubled. Now, as yet, where we are in the economy, that those assets are not being driven into distress for a whole host of reasons. Banks not sort of foreclosing and giving people time to pay, and all landlords giving tenants time to sort of pay, etc. So they're not being forced into any sort of distress at the moment. So so there does generally seem to be a sort of there's obviously a lot of capital expecting distress. Whether it will come through in the same sense as the GFC will be sort of to be seen. And I doubt it to some degree. I think investors should be careful about fighting the last war, so to speak.
Okay, good. And just looking at the I suppose the sources of capital. Jason, what are you expecting? Are you expecting to see, still North American money maybe being dominant in Europe versus Asian capital? What's your sense of the sort of next 12 months going forward?
Well, in terms of investment volumes, yes, with only recent evidence or data to look at, but yes, the US is the dominant non-European force in European real estate, and I think even as in representing commitments to funds, it will continue to be an incredibly important and dominant source as well. I think the proportionality probably won't change. We've seen, US increase amongst non-Europeans, and we've seen domestic European investment increase as a proportion of overall European activity. But it's all, it's shares of a smaller volume, and I think that is being impacted by, a withdrawal of liquidity, as was being said earlier, particularly by Daniel. The asset managers and institutions are focusing on their existing portfolios. Particularly the pension fund community is under pressure to release capital to many of its beneficiaries, which is going to reduce the amount of capital they have to invest in in the real estate and other sectors. So in terms of global capital movements, mobility is also just incredibly hampered, physical mobility. So we're not yet long enough into this and to know the permanence of it for us to be seeing permanent changes in how due diligence is either for real estate investments or for commitments to funds has been changed. But our expectation is that we will see a degree of mobility resume in the near to medium term, but it's extremely frustrated at the moment.
It's interesting. We've got a couple of sessions later on coming up after this. We've obviously got one on the outlook for Asian capital, both in terms of what's happening in Asia, but also the outlook for capital coming towards Europe. And then later on, we've got a couple of sessions focused around North American capital, Canadian and US, and it'll be interesting just to see what the views are also in those sessions. Daniel, from your side, I mean, you mentioned there, and Jason mentioned that, you don't really see the world changing hugely in terms maybe of office or cities, so does that mean from a strategic point of view, the kind of winning cities side of it is still going to be a kind of core focus? You don't see those cities changing? I mean, Jason mentioned there that if something's been, if a city's been around for several thousand years, the chances are that 6 months isn't going to change that. Just interested to pick up on your thoughts about that.
Our focus generally throughout our investment across Europe and the US has always been on major capital and gateway cities. So we've stuck to the major cities, capital cities and gateway cities in Europe, and in the US we've invested in New York, Los Angeles, Miami. And I think generally I don't see those changing. I really don't. I think the cities in themselves may have some ups and downs. New York is not going to disappear off the face of the earth. It's going to be the most vibrant city in the world. It will be again in a few years' time. London is a city of 10, 12 million people when you include all the areas. Paris, these are major cities. Barcelona, Madrid. People want to live in cities. Things may change. People may say, I don't want to live in a high rise anymore. I might want to be a little bit more sort of suburban. But fundamentally, these cities are going to survive. We are not, unless you believe we're all going to work from home forever, and then no one's ever going to go back to an office, and I can work wherever I want to. And I'm afraid I don't believe that is the case. I think we will ultimately get back. Businesses require people to be in the offices. Those office areas are not going to change because there's, they are where they are. People need to live near their offices. So ultimately, cities will return to their vibrancy. I think people have short memories. I think that's generally been proved over time. And in some ways, it's quite comfortable to sit at home and, doing this today. I'm sitting at home. I didn't have to get up very early, get up into the office and do all these, get there and be up at 6 o'clock. It was more comfortable being from home. But that's just not the reality. That's not the way. Look at this panel. It's great doing it like this, but it would be better if we were all in one place doing it together. And in that respect, cities are going to continue to be dominant. These mega trends over the last 20 years are not going to change. They may change in the terms of, as we talked about before, people may not want to be so crammed into their offices. So what will that mean for office occupancy? Retail, things are going to change. Do I think, if you walk around Regent Street today and Oxford Street, it's quiet. But once the offices come back, that retail will return. What formats those stores will be, how different they'll be. I think those, again, are just trends which were coming anyway. But ultimately, cities are going to be dominant. And I think if you invest in a gateway and capital city mentality, I think that will prove ultimately to be the right strategy.
Interesting question here from David Allen coming in. Thanks, David, and hi. How are you doing? Hope all is well. I will ask it just on this, which is just because it's a trend that we've also been seeing. I've seen a couple of things coming in around this on the news front. So does nobody think that people should be looking at office to resi conversion in CBDs? Anybody want to pick that point up? Not directly capital flows related, but nonetheless, what's your sense of that? I mean, you're obviously a believer in office. Jason, does that mean that you're less likely to look at this kind of office to resi conversion, or is it just a question of where there's the right opportunity?
We touched on earlier that resi is very popular, but it's not foolproof, and the success of a residential location versus an office location might be driven by many of the same drivers. What are the local amenities? What is the convenience of being based there? How much is that bound between the proximity of life and work? So I think office to residential conversions are still going to provide an opportunity, not least. And this is nothing really to do with the pandemic, not least because stock becomes obsolete and its reconversion into office might not be the best use for it. But I think if the location offers an attraction, it will probably apply both to office or residential use. It just may be that the building is no longer suited towards office use. And in particular, if office needs are changing, as may well a residential one. So, one of the big differences, particularly in the office sector, I think, in this downturn, is that we're going into it without riding on the crest of a wave of huge speculation in the office sector. And normally, any economic downturn is crowned with euphoric speculation in real estate, and offices is often a sector that suffers the most. That just isn't the case this time round, and so we are entering what will be probably a more fragile period of office take up, but in an environment where vacancy rates were incredibly low, well below long-term averages in some major cities. Below 2%, and so in the event that there is less demand for offices, and vacancy creeps up, we don't envisage it being to an alarming degree. And in particular, as Daniel was describing, if the way in which office occupancy needs to be managed, we opened up our office again this week. but as you can tell, I'm not I'm not sat in there because we need the same amount of space to occupy 1/3 of the number of people, and so that is going to put pressure on the need for office space as well. So if anything, that that may quell the need to change of use of some of the existing office stock, because it's going to be needed in a low vacancy environment and possibly a less dense occupancy environment as well.
Okay, good.
I just had one thing there. I think actually it's not necessarily going to be offices that are converted to residential. I think if you look at the need to get vibrancy back into the cities, it's going to be retail that's converted to residential. If you look at John Lewis, for example, on Oxford Street, they've already come out and said they're not going to need their entire store. They're going to probably keep basement, ground, first floor. The rest is going to become some other use. Whether that use is offices or whether that use is residential, to be seen. But you look at the high streets, if retail is changing and they all have these, second, third, fourth floors, that will change more tenanted to offices or retail. So I think actually the most conversion in city centres is going to come from repurposing retail rather than repurposing offices. But the one thing to be wary of is if you're in the centre of a major city, that residential is going to be very, very highly priced. It's not going to be mid-priced residential that is feeding the mass market. It's going to be high-end residential. And how much more high-end residential do these major cities need? I think actually most of the greatest need for residential is around providing rental accommodation for office workers and also providing mid-market. And obviously city centre is very challenging to be mid-market because of the entry price point of the asset.
Okay, good. Some interesting things there actually for the sort of winning cities session that we've got coming up later. There's only a couple of minutes left here, so I just wanted to come to everybody and just sort of in kind of 2 minutes each, just give your I guess assessment of what you see as the key trend for capital flows over the next 12 months. Let's start with you, Jason.
Well, I think we're going to see a reduced level of activity in terms of capital flows, both into funds, both directly into into assets. But I think we're going to see a lot of appetite. We're just going to possibly see less activity. One of the issues, particularly in the direct marketplace that we talked about, is the way that capital is organised in Europe is very much large scale investment, and I think the European landscape is actually quite granular in nature. And whilst Q2 volumes have unsurprisingly fallen, volumes for H1 this year are equal, if not higher, than last year. And that's very much driven by the dominance of large scale capital. So down at the 50 million euro or less lot size, I think volumes or deal number is down over 55%. So there's a real withdrawal of liquidity there. And I think going forward, how we're going to provide capital flows to that more granular and large part of the real estate market in Europe is going to be key.
Okay, great. Daniel.
I think, over the short period, the biggest issue in capital flows is travel. Right? Real estate is you have to go and see the asset. Actually, we're looking at in Germany and today, but as a UK citizen, is to go to France and Spain without the quarantine issues. Therefore, I think those cities those countries, should I say, that have the strong domestic markets, I think are going to probably outperform over the next couple of years. I think over the next few months, I think those countries that are struggling to handle the virus are going to probably be weaker over the shorter term. But I think as you go into sort of spring 2021, and hopefully the worst should be well behind us, I think it will probably start to even out a bit more. So I think you've got really a split market where the next 6 months will be dominated by those countries that are in a better position and have got strong local markets. And then over the course from 2021, I think it will again be a real focus on major cities. And I'm a big believer in the capital cities of Paris and London. I think they will London, I think, will be a little bit more challenging over the next few months. But I think once we're into 21, I think London will be a real winner moving forward.
Okay, great. And the last minute to you, Simon.
Yeah, sure. I mean, obviously Jason and Daniel have said a lot of the relevant points that capital is going to be slower. Our experience in Asia so far. Asia went into the crisis earlier. It's some of the countries over there have come out of it earlier and eased their lockdowns earlier. Though obviously some of them are going through second and third waves of COVID. But what they haven't seen is a recovery in investment volumes. So maybe that's a warning for Europe that coming out of an economic lockdown does not equate to rising activity straight away. It's going to take a while, and investors are I think investors are on the side looking for that distress, looking for those price discounts, and it might be a case that investors at some point over the course of the next 6 to 9 months need to sort of come back to the table at sort of prices similar to what was on the market at the end of 2019. So you might not see massive discounts across a lot of these markets, particularly for the core assets in core cities that Daniel and Jason have talked about. So I think we're going to be watching that pretty closely. What I would also say is that so far the equity markets in general have been pretty robust, surprisingly robust. I would argue. I'm not an equities analyst, so I don't know the real underlying drivers for that. In the GFC, we got hit by the denominator effect, where pension funds and investors had to rebalance their portfolios to sort of equate for the falling equity prices. We haven't had that this time round. Whether those models have been adjusted over the last 10 years, or whether if the equity markets start to adjust to the realities of when job prevention programs start to ease and economies sort of get back to normal and we start to see real problems, then maybe the equity markets fall and we start to see a little bit of that denominator effect hit some of the allocation.
Very interesting to see how this extraordinary year progresses. Thanks very much, Daniel. Thank you, Simon. Thank you, Jason, for your time and sharing your insights this morning.